Hey traders, in this video we are going to look at how to take advantage of the volatility. Stay tuned. Hey guys, welcome to you. Thank you for joining me. Alright, so when I'm filming this, we have got coronavirus volatility. We've had all sorts of news coming out. Markets just going crazy. I've done another video which will be uploaded or already has been uploaded. Maybe you've come to this one. From that one, we'll talk about managing the risk. And I want to say there is no problem or shame or anything about sitting this volatility out. In fact, for most people, that is exactly the best thing to do, okay? What we really want to do is still be here to fight another day. But we've already done that video, but that being said, if you want to take advantage of the volatility, here's some things that I think are worth thinking about if you're going to put your capital to work and you're going to put some money at risk. All right, so the first one is adjust your metrics to the new average true range. Pretty obvious, but worth saying. You know, if you normally had a stop of say 30 points on the Dow or 3 points on the S&P or whatever you're trading, make sure you adjust the order of magnitude for the volatility. It might well be that you now have a 300-point stop on the Dow, and that may well put you out of the game because the size of the stop, if you're trading futures, may well be too much. So CFDs, spread bet are always quite handy because you can trade, you know, a smaller position size. So for this volatility, it's fine if you don't want to risk, you know, much of your account. You want to be able to adjust and play with things. You can trade with a little bit smaller size. So that's worth thinking about. So adjust the new ATR. And actually, literally just the other day, guys, we had a Dow candle in 1 minute that was the normal daily range we've had before. It was like a 175-point move in 1 minute. And that wasn't even on the news, just to the end of the day, chopping back and forth. So, you know, bear that in mind. Look at the ATR of whatever you're trading and recognize, hey, my stops are this much wider, my target's this much wider. Let me just dial everything down. So dialing down the position size to account for the increase in volatility. And expand your noise level. So I don't mean this by news noise, I mean it by price. So if you're trading, you know, we know that generally speaking, you know, we have, markets will do this. Let's say the market's going to go from here to here. You know, very often, you know, they're going to do this, right? They're going to be noisy. So you've got this kind of chunk where there's a noise level. I don't mean a trend line, I mean there's just noisy candles. And so you have to expand that. So in other words, when you may go in and normally look for, let's say a 25 tick scalp or whatever it may be, that 25 ticks is probably going to be there within 5 or 6 seconds. So you can't really look for that because it's unlikely you're going to be able to define that. You're probably looking for more like a 100-point scalp if the daily range is so big as a 1,000-point range. You get the point. So adjust your noise level, and sometimes you have to recalibrate. And one thing I didn't add, guys, if you're day trading this, just take the order book off. Don't bother with the order book unless you're using it to input orders because it's just so quick. There's so much going on. Your mind and brain and subconscious is calibrated to the normal movement, maybe to some sort of kind of with some extremes. And when you start seeing this, it's going to be hard to process. So, and you're going to kind of fall back on your habits and the way that you normally process that kind of move, which won't work in this environment. Number 3 is be aware of headline risk. Sounds obvious again, but we're in a headline-based market, guys. All it takes is for one headline to come out. In fact, yesterday, Fed came out, cut by 50 basis points, bang, market just ripped to the upside as you'd expect. Now, we're going to talk a little bit about what happened after that in a moment, but headline news is there. If you were short, your face just ripped clean off. So be aware of that, accept that. We talked about this actually a while ago in some of the videos that are probably should be up on the channel by now. Talks about the Trump tweets, and when Trump was tweeting with this headline risk, and you had to accept this risk. But then the spikes were like 100 points on the Dow. Now we're talking 500 or 600 points. Crazy. Okay, I take more time to plan out scenarios. This is what I want to talk about the Fed as an example. So, you know, when we are normally trading, we might have a few trade ideas and what happens if this happens, that happens. It's far more scenarios that happen when we've got headline risk. So in the case of when I'm filming this now, we've got this coronavirus, whenever you're watching this or whatever other situation, there's always going to be multiple scenarios. So for example, might have best case scenario. Hey, coronavirus now is dying down, people are getting less infected, death rates falling, etc., etc. You know, just positive news coming out that's confirmed. Everything is not just speculation from some guy on Twitter. And then we start to see a rally off that. So how will you prepare for that? Will you buy that? Will you, how will you trade that? Maybe go to the other side of the coin where, hey, the virus has mutated, death rate suddenly spiked, or whatever it is, right? And then you see that headline coming out, and then everything in between. And also the issue with how monetary policy is going to be affected. Are the government going to, or is the government or the president going to say something to affect things? Are they going to pump money into the system? Are they going to restrict things, good or bad news? So all these things need planning out in your mind. And one of the things that was obviously on the cards was some kind of Fed cut, right? But the thing is your plan after that. And actually this worked quite well for me, because just as a pure example here, guys, is that, my thought is, okay, if we get the surprise cut, market's going to rip, all right? But what happens after that is exactly what we're looking for. Unexpected response is what we call this. And that then gave an absolutely beautiful opportunity, because I was prepared for this and to take a short on the kind of sell the news type trade. Now, if you're not prepared for it, maybe you'd have chased it, maybe you'd have got caught out or whatever. So listen, it's just an example, and there's plenty of times we get trades wrong, which is why we manage risk, of course, but being prepared and knowing how you're going to react to what you want to see. So I want to see the spike, I want to then see it fade, try again, and then start to fall through that low. Great, off we go. We're going to take the short. We know our risk is going to be. Let's see if it will go, and then we'll kind of buy it back as it goes through all the stops underneath that Fed, pre-Fed level. So anyway, just a kind of example, guys, but planning out scenarios in your mind for whatever asset you're trading. The other thing is, be very, very mindful of your daily and weekly risk. I mean, your dollar risk. If you're risking X amount per day, X amount per week, stick to it, because it might happen so quickly, you just get bang. Oh, that caught me out, that trade. Wasn't ready for it, didn't get my stop in, whatever it may be. You take another, Before you know it, because the move is so big, and because the margin is still the same, but the move is so much bigger, all of a sudden, effectively, you've got more leverage in your account. Because just the volatility is just 10 times as much, so you've almost got 10 times the amount of leverage. So you've got to be careful with that. Be mindful, don't get caught out. I've been trading and gone, oh, actually, careful, you've taken a few trades here, bit of a drawdown, reset yourself. Go back to the method, go back to the strategy, and you've got to catch yourself quick, because it's very easy to take a few trades, especially if you're day trading, take a few trades and then go, whoa, actually that's more damage than I would have liked, just because of the moves and this and that and there's slippage and all this other stuff. So you take stock of the situation, come back in, reassess, calculate your grade A plays, and go again. Oh, guys, just don't chase. Same rules apply. Same rules apply. Even though we're going high, 800 points, 600 points, whatever it may be, still don't chase, still wait for your sweet spot. And that means you're going to miss stuff. But, chasing, if you look, when the markets looked at the very worst, it kind of, have these face ripping 300-point rallies before it goes again, and same kind of thing. So even though, we look like we're getting these extreme moves, and yes, if you can get on one and you can ride it, it's beautiful. It's great for your account. It's great for your confidence, all these kind of things. But the FOMO can be much more of a problem, because the move is so much bigger, and oh, wow, look at that big move, it should be on it, we're recovering, we're going to crash, all these things. So just be very, very mindful of that. A little caveat I've put here is, unless it's breaking news and you're prepared for it. So in other words, let's say you'd planned to do X on some kind of positive news, you planned on buying it, and you've got a risk parameter in place, you know what you can do, then fine. That's a different ball game. You see it pop, you kind of wait, and then you buy it and you chase it because you think there's a catalyst that's going to make it go higher. But that's a planned trade. That's a different scenario. But what we don't want to do is just chase stuff because I think it's going to go higher, I think it's going to go lower, and you want to be on board it, you want to be on the lower, whatever it may be. You get the idea. The other thing, guys, is to expand your holding time. An easy way of doing this, easy is definitely not the word to be using in this market. Challenging, but with a lot of opportunity. So, if you're expanding your holding time, if you're reducing your position size and expanding your holding time, the good thing about this volatility, guys, is the ample opportunity. There is so much opportunity here. You don't have to be taking substandard trades. You can wait for trades. Now, are they always going to work out? No, of course they're not. But if you've got good risk management in place and you're just sticking to your rules and you're adjusting and you're flexible and you're doing the homework and you're having your rest and all these things, then it can be an opportunity. But if you want to stand aside, and again, as I said at the beginning of the video, there's no problem in doing that whatsoever, because the market is a different beast. It's a completely different scenario. Everything's trading differently. All the rules are kind of out the window. Of course, your risk management stuff, but all the things that maybe you normally look at for little tells and clues are gone, but it'll come back to normal. It'll settle back down. But anyway, that's the point. Expanding your holding time. One way of doing it is reduce your position size, expand your holding time a bit. Maybe you're normally in for a smaller holding period. Just bring out a little bit, just dampens off that volatility a bit so you can capitalize on the opportunity without and the kind of extended moves without the volatility, really being, a kind of a negative impact on your trading. So expanding your time horizon, reducing the position size allows you to capitalize on that side of it, but actually not with the other side of the negative side of the volatility, which can be just getting cut, whipped, because it is wild action. Anyway, guys, those are some things, in my opinion, to take advantage of this volatility. Now, listen, stick to your plan, stick to your rules. Stay out if you want to, if you need to, live to fight another day. Great learning experience, even if you're not getting involved in this. But if you're confident enough to get involved in it, you've got the risk management dialed down, then some ideas there to attack this wild market. Take care, guys, and keep your risk managed. Bye bye.